morning and welcome to this week's Investor Corner. Many of you have probably seen the videos I've been putting out this last week on Facebook and on Instagram, kind of talking about the overvaluation of the Spokane housing market. For those of you who haven't heard, there was an article that came out that outlined the most overvalued housing markets in the nation, and Spokane ranked number 6, which is just nuts. So I've been doing these small videos, kind of dissecting piece by piece this article as well as some of the local data. This is meant to be an all-in-one video where I provide you with all of the data and I also give you all of the links for you to do your own research. So part of being wise investors is taking a look at all of the data to make sure that what we are doing lines up with good business practices. So I'm going to provide all the links for you. I'm going to kind of mention each of the different pieces and when those links are going to be applicable. So I'm going to kind of go through this in a faster manner than I am in each of the individual videos. Should hopefully be about 10 minutes, but hopefully provide some good insight as to what's actually happening in the housing market nationwide as well as our local housing market. So like I said, Spokane is ranked number 6 as far as most overvalued housing markets. What does that actually mean? So basically what the study did was they looked at the housing market nationwide and they said, okay, this is the trend line that we have seen over the last couple decades of how much housing prices are supposed to go up every year. So the number I've heard statistically in the past is 4.6%. I would imagine that that's probably what they're taking into account as a pure value of the housing market. So they were comparing 100 different markets to this to say, okay, which ones are the most overvalued, which are the most undervalued. Spokane ranked as 80%, or no, Spokane was, I think, 65% overvalued, and Boise was 80%. Boise was the number 1, which basically means they believe that housing prices have gone way off the rails in those cities. Spokane was here. And the one that ranked the lowest was actually Honolulu, Hawaii, which ranked 4.6% below the average that they were expecting. So I think this study was flawed in a lot of different ways. I think they only took inflation into account. They might have taken the median home price nationwide into account a little bit, but ultimately all they were looking at was what have housing prices done in the past, where are they now in comparison to that, and this tiny bit of data that they extrapolated has turned into just national news. Everyone in Spokane that I've talked to is talking about this article and has heard about this article, but doesn't really know what to do with that information. So a couple things about the study itself. First of all, they studied 100 cities in the US. 95 of them, they said, were overvalued, and 5 of them were undervalued. The overvalued ones ranged from a couple percent up to 60 or 80% in the case of Boise, 80% overvalued. And on the low side, the lowest was about 5 or 5.5% undervalued. So very small margin, 95% of markets they believed were overvalued. So to me, that means they probably were looking at their data in a way that is not continuous with the other factors in the market. They were simply looking at a couple data points and trying to create an article out of it. So, so where does this kind of go off the rails? So the first thing I'll talk about is mortgage rates. You've heard this, mortgage rates are super low. You know they're lower than they've ever been. There's a graph below that kind of talks about historic mortgage rates. And as you can see, it's a downward trend. Rates have been going down for the last 30 years. 30 years ago, 20 years ago, you would have a 16, 18% mortgage. Your home would only cost $35,000, but you'd be paying a huge amount in interest every month. Now, homes are significantly more expensive and rates have gone down significantly. The federal government is aware of this and they don't want to raise rates very quickly, and they don't want to raise them very much because they know when they do that, it's going to cripple the buying power of the average American buyer, and it's going to do some hazardous things to our economy. So the Fed is being very careful with that. When they talk about raising the rates, they're talking about 0.25% or 0.5%. So even looking at this next year where they're talking about raising the rates once and twice in 2023, we're talking maybe 1.5% over the next 2 years that interest rates are going to go up. We're still going to be at 4.5%, which over the last 20 years is still historically low. So as long as rates continue to stay low, prices are going to go up. That's natural. When money's cheap, you can buy more things with it. And the second thing that's affecting is the number of first-time buyers in the market. Something like 25 to 30% of buyers in the market are first-time home buyers. So that is a ton of people that are finally buying their first homes. In the other side of that, people are living longer and staying in their homes longer. So 35% of homeowners are over 65 years old. So to put that in perspective, you have 35% that are, drop the pen, that was awkward, 35% that are over 65 years old, 30% that are buying their very first home, and there's just simply not enough homes for the number of homeowners that we have in the market. So it's not flooded with investors, it's not flooded with anything else. This is very average. When there's a high demand and a low supply, prices are going to go up, and you're going to see 95% of the country have an overvalued market simply because supply and demand is taking effect. So I have graphs that support both of those. You can kind of extrapolate your own data from that, but what I'm seeing is that there's a lot of buyers, young and old. People are not retiring and moving into retirement communities. They're staying in their homes into their 70s, 80s, 90s, and young buyers are coming in and owning homes and staying in them for longer periods of time. The next thing we can look at is the low vacancy. In 2005, leading up to the 08 crash, vacancy was about 1.2%. It went up to 2%, 3% in 2007, and by 2008, it was at 4%. So we're at 1% vacancy. So that means that people who buy homes, whether it's an owner or an investor, they are living in them. So nationwide, that's going on. Leading up to the 08 crash, we saw this increase in vacancy, which means there were more investors buying speculative investments in the hopes that they would go up in the future. So when that happens, there's naturally going to be some sort of shift that takes place in the market. We're not seeing that in our current market. We also have 65% of people own homes in the United States. So 65% is a very average number. In 2004-05, we had about 69%, and then it dropped leading up to 2008, where there was more investors and less owners, like individual owners of homes, and it went down to about 61% before the crash when everything turned around. So more investors buying more homes that people were not living in is going to turn the market. What we're seeing right now is 65% ownership. That's a very healthy level. Or 65% of people own homes. That's a very healthy level, something that we have seen shows stability in the market. In addition to that, investors are not buying as many homes. So there have been caps on the number of homes that investors can buy as far as like the federal government. They used to just fund loans, however, a little higher interest rate for investors, but now they're even tacking on more and more fees. And the federal government has says they're going to cap the number of investor-owned loans that they will buy at 20%. So again, what they're doing is saying we want people to own homes. We don't want huge mega investors to have tons and tons of property. So we're going to make it a little bit harder and the cost to acquire those homes a little bit higher. When the cost goes up, when they're harder to acquire, then hopefully that's going to keep the number of investors out of the market. So then we can have more owner occupants and we can have a stable market, which is what we're seeing. We're seeing a very stable market right now. Other thing, new home costs. Labor has gone up, lumber has gone up, sinks have gone up, plumbing has gone up. Everything has gotten more expensive. So as a result of that, the cost to build a new home has gone up. So the price of a new home has gone up. So neighborhoods are designed so the next phase will always be more expensive than the prior phase. So if you bought a home in a new development, you spent a certain amount of money, the next phase that was built is going to spend more money for the same homes. Next is going to spend more money for the same homes. So developers do that on purpose to ensure that there's equity built into their homes that they are selling. that naturally, as there's this kind of forced inflation going on in the market, prices will be rising in a given neighborhood. So, but in addition to that, we've seen that just the cost of doing business has gone up very significantly. So in Washington and California specifically, we have a very high minimum wage. So Washington is the second highest in the nation. California is the highest. When people make more money, they have more money to spend. And when people have more money to spend, they're going to be buying more expensive homes. They're going to be willing to bid up the price because they know they can afford to spend a little bit more. And then that's kind of on the state level. On the local level, we can see that, and again, there's graphs for all of this, that the local economy is doing really well. People who live here are making more money than they ever have. Part of that is we have better jobs that have come in. So we have a couple of Amazon distribution facilities. With that, we have warehouse workers that are making a good livable wage. We have higher up executives that are making significantly more. Our healthcare system is expanding. There's just more money flowing around in the market. So our local economy is very strong in that sense. And in that same sense, we have more people that are actually working in our local economy. So check out those statistics. I think it's super fascinating to see the growth that we have seen there and the growth that we've seen in our local economy as far as the number of workers and the amount that they're making has a direct correlation on the amount of money that people can spend and are willing to spend on their homes. So all of those factors come into play when you're looking at the valuation or overvaluation of a housing market. And I think ultimately what that leads me to believe is that we should have very high confidence in our market that we are not heading towards some sort of collapse. There's not a crash coming. There's not probably even much of a correction coming, if any, even when rates go up, because people can spend more money, and when people can spend money, they will spend money. So things that could turn the market around very quickly, if the federal government decides to raise rates significantly, that would obviously have an effect on the market. If for some reason some huge sector of our Spokane industry gets completely cut, so if Amazon packs up and leaves, if our healthcare system shuts down, if Fairchild shuts down, if our schools shut down, those things would have a huge impact on our economy and could turn our housing market a little bit, or if a bunch of people leave. So that's the final thing I want to hit on. Over the last 10 years, we've had 50,000 people move to the Spokane County area, and we have had 20,000 homes built. So there's a 30,000 home deficit just in the last decade between the number of people that have moved here and our increase in population and the increase in the number of homes. So we already have a shortage, and unless someone's going to show up and build 30,000 homes very quickly in the next couple of years, we're going to continue to have a deficit. So unless people start moving away from Spokane, which could partially be because homes are becoming priced higher than some locals can afford, if that is the case, then potentially we'll see a shift, but we need to see a really massive exodus before any of our local economy or our local supply and demand in the housing market is actually affected. So in summary, yes, our home prices have gone up faster than the national average. They have gone up significantly faster than most cities in the United States. And according to this statistic, it is probably the 6th highest increasing value in the nation. But there are a ton of factors that have played into that, both nationally and locally, all the way from the state and just the local level. There's a ton of data to support that, and I think we have a very strong housing market here in Spokane. It's a good time to invest. I personally think that we're going to see another 10 to 20% increase in prices this next year. It might level off in 2023 if rates go up to that 4.5% level. But until then, prices are going to continue rising very quickly. So don't wait. If you're interested in investing, I would love to talk to you. I think this is a good time. Something I'm actively doing myself. Practice what you preach. So if you have any questions, hit me up anytime. And thanks for watching.